So I guess the broad themes, we'll come back to this in our discussion, but it was really aimed at those who were either considering raising equity from real estate that they own or are advising people who do that. And secondly, whether occupiers are looking to perhaps raise finance from real estate assets in the next 12 to 18 months. So those are the broad overall themes which would have been the poll, but which are now part of the discussion. So I guess to set the scene, Charlie, maybe you could let us have your thoughts on a few things. So what options would you see real estate owners having when thinking about financing in the current climate? When is the right time to go or no go on realizing some value from real estate? And what are the options around structuring that? So over to you, Charlie, and then I'll bring in the others to talk about those things too.
Sure, yeah, thank you, Robert, for that, and good afternoon, everyone. And just to set my comments in context, I look after the real estate investment banking business at RBC here in Europe. And that's a business that sits alongside our lending colleagues who cover the full spectrum of lending, from commercial secured mortgages through corporate unsecured into debt capital markets. And whilst I look after the European team, we do so alongside colleagues out of Canada and the US and also Asia Pac. And I think an opening observation from me in these times of ongoing uncertainty, both from a lifestyle and also work style perspective, is that in a low interest rate environment, which we were in pre-COVID, and it seems likely will remain in for the foreseeable future, assets that generate a yield are going to be extremely well bid by the capital markets, whether that's to borrow against or whether that's to bring in new external equity to help finance. And so if you are an owner of assets that doesn't necessarily need to own them on their balance sheet and has a desire to monetize, either perhaps through complete disposal or, more relevant to this afternoon's conversation, for ongoing occupation for which there will be an income stream, perhaps still described as a rent, albeit we know that lease structures are evolving, then the reassuring news is that there is a deep and broad pool of capital markets demand there for you to tap into. And if that's setting the scene, and we might pick up on some of the examples of transactions that have happened recently to evidence that demand. To your second question, Robert, on the timing of those options, well, we know from the news across the main occupiers of real estate that most businesses are reviewing how they do things, whether that's the ongoing discussions about retail and retail evolving into e-commerce and therefore warehousing and logistics, and also business space from traditional offices through to the more recent but very well-backed, operationally geared, flexible and service office sector. Also, residential and the other previously regarded as alternative healthcare and student accommodation sectors. All of those businesses, it seems, are reviewing how they do things from a core corporate operations and also from a financing perspective. And the time for considering what those options are and whether it's the right time to execute, I think depends largely on where those businesses feel they are in their decision-making process about moving to a not necessarily post-COVID, but post hard lockdown world. And we may be in that situation now, or this may be a timely discussion as we think about entering that in the future.
I mean, I guess there's the initial stage as well, isn't there, in terms of businesses evaluating what their actual space needs are going forward, given changing working patterns, probably changing living patterns as well. I.e., do they have surplus land? So are they looking to do something with an asset that they will need to retain and want control of, which lends itself to perhaps an equity investor or a partial release of equity on IPSX, for example, versus, well, actually, do we need this land at all anymore? Can we do something more useful with it? Can we maybe combine it with other sites to do a wider project? and that's more of a straight sale, I guess, rather than keeping a controlling interest. But I mean, Charlie, do you want to come in on that? Sorry, Roger, do you want to come in on that one?
Yeah, thanks, Robert. Yes, I mean, I think for owners of assets, owner-occupiers of assets, we think, I mean, Charlie alluded to the flexibility. The flexibility of using an exchange obviously means that whereas previously the options open to owners were fairly binary, sale and lease back. Obviously, we saw joint venture structures, sometimes involving multiple assets, but they were very complex to set up, even more complex to ever envisage unwinding. And we find at IPSX, when we're talking to owner-occupiers, that operational flexibility is incredibly attractive to them. Not least because sometimes if assets have been owned by a company for many years, the idea of selling them and becoming just a tenant forever is rather final. And of course, one of the features of assets listed on IPSX is that they will be companies, and amongst other things, that means that there is a process for you to buy back the equity that you've sold, if should you ever want to. But I think also there's the speed issue. I mean, this might make a lot of people listening smile when I say this, but IPOs are actually fairly easy to execute. It's a process, cumbersome and involving a lot of hard work by a lot of people, but it's one that everyone is very familiar with. And it can be done quite quickly. I mean, the IPF will tell you that the average time to sell an asset in the direct capital markets in London today is 189 days. And it might need a lot of organizing, but you can do an IPO faster than that. But I think, Robert, lastly, the thing that I think is most interesting about this new option that's open to owner-occupiers is the ability to engage with different types of capital, different sources of capital, and not least possibly your customers and perhaps your employees who could be given the opportunity to invest into the business. And for a lot of companies, that's very attractive and interesting.
I think that's the wider theme, isn't it? It's kind of community engagement in the broader sense. So certainly the development world is going that way. So the government's impetus around, more coordinated, more design-led schemes rather than piecemeal development. And I think having community engagements in that sense is important on the planning side these days, which we're doing a lot of work on, but also engaging your employees and your other stakeholders in the business. So yeah, I see that as a big advantage. If you can sell shares more widely, going back to the 80s concept now of SID, you can bring in your employees, bring in your customers who will have a tangible investment into the wider business, especially if you do something that would attract an impact investor, for example. That's the other big trend at the moment. So yes, yeah. Dom, would you like to, in terms of valuations, how does that interplay with what we've been talking about in terms of the investment pool?
Yeah, no, very much. So I think obviously my focus is working only with occupiers and looking at their freehold portfolios across Europe. And I think what we've probably seen over the last 6 months is an initial focus on the operational elements of their business. They were looking to deal with how they can still maintain. Through that now, we've had a lot of requests. We're working on a number of projects now with other departments within CBRE, where organisations are assessing what space they need going forward. What should their footprint look like in a and from that will then identify what do they do with either the surplus space or the core space. Can they save money through OPEX, or can they raise cash through disposals? And there's a lot going on, and these are quite complex projects, and they do take, from my own testament, many weeks to put together. But I think that's what's going through a lot of occupiers' mind at the moment. How should our business look like coming out of COVID? And what do we do? How can our real estate support that? And as Charlie alluded to at the start, for long income, there is a wide pool of investors, shall we say rather, who are willing to pay aggressive yields to secure that space, given should it be a strong covenant.
Which, of course, Robert, I mean, of course, that makes sense, doesn't it, Dom? Because if you take a building like BAT's one, which is just about to be put up for sale, that's a single corporate covenant. It's an investment grade covenant. And you would be getting a yield from real estate way, way, way above what you'd be getting from bonds that have the same covenant. Now, I know bonds and real estate are not exactly the same, but the cash flows can be structured to be pretty similar.
Mm.
Yeah, absolutely.
And you have flexibility about the level of stake, if you like, you could sell down. So if the business is particularly concerned around retaining control of the asset, then a sale of a minority stake in it, whether to an investor or via IPSX, for example, would be an option. Particularly if you had some kind of employee participation as well. So it works on a number of levels, I guess. I mean, do you think, Dom? Do you think, in terms of when to go, do you think real estate values in particular sectors are pretty much as low as they will get, or do you think there's further to go? Or I mean, it probably varies between asset class, but what's your thinking?
Yeah, I think that's right. I think it very much varies between asset classes. I think we've seen a hierarchy of the various sectors which have been impacted the most over the course of COVID. If you look at the logistics sector, that's been relatively robust, and actually we'll see some deals coming through across Europe now, which will show stronger pricing than pre-COVID times. So that's been probably the beneficiary, but obviously a lot of that is due to the increase in online shopping. And therefore there's obviously a loser in that sense, which is retail. Obviously the bricks and mortar retail have suffered. This has accelerated a trend which was happening well before COVID, really. And is there further to go with retail? Perhaps. I think it's really difficult to predict the future. The office market, I think, is a really interesting debate. I think my initial view when COVID hit and everyone was able to work quite efficiently from home, is that the office market is going to struggle. I think more recently there's been a change in mindset and change in thought. I think organisations are realising there is actually a benefit of having that collaborative space. We expect there's going to be a flight to quality, so that those high quality, well located office premises will still show strong demand. And interestingly, we think there's going to be a reduced densities in offices over the course of the last 5 to 10 years. Fundamentally, most organisations have been squeezing people into less space. Now, given the social distancing, even post-vaccine, we do believe that many employees will have a degree of anxiety. So therefore, we expect that occupiers will still require good levels of office accommodation, but supporting fewer people using them, and arguably more collaborative space as well. So I think the office market is an interesting one. It's very difficult to predict what's going to happen in the future, but I think I'm more positive than I would have been maybe 6 months ago, or 6 months ago, shall we say.
Yeah, and I think, Dom, I would add to that, just from our own experience here as a company, when we're talking about going back to the office, I think that in addition to everything you've said, I think when people are quite comfortable about the idea of going to the office, what worries them is how they're going to get there. And so I think that sites which are close to mainline railway stations, so you don't need to use a tube in London, or better still, offices in the regions that have car parks that you can drive to. These are going to be much more important factors than they used to be.
Yeah, I would absolutely agree. I think occupiers' footprints will change over the coming years as they look to have a more flexible working environment, and I think that will depend on where the various buildings are located. It's going to be a key element to that.
And I think certainly for retailers that would own their own space or offices, I think there's still a lack of data, I guess, isn't there? I mean, we don't necessarily know fully what the long-term trends will be, except that we are, I sense, living through history. And I think we'll look back on this as a semi-permanent change, both in working practices, how we live. Certainly retail has accelerated, but that trend was happening anyway. But I think, the bigger themes are trying to integrate communities and integrate sites. So the government policy is very much driven in this area, into larger mixed-use schemes. As Dom said, it's trying to make the best use of the space in a design-led and an intelligent way, rather than essentially just a piecemeal approach to development. So that's certainly what we're seeing, and ideas like garden cities where stakeholders can get involved. I mean, that would lend itself to IPSX as well if you had several sites coming together, which you could then have the community owning a piece of, as well as maybe a cornerstone impact investor, because a lot of the bigger funds are looking at impact investing now. So the whole kind of holistic approach, I think, to real estate and development is something that will only continue. I mean, Charlie, are your investors that you work with, is that a broad theme, impact investing and that kind of broader stakeholding idea, or is it still kind of very much around the nuts and bolts and the valuations?
Yeah, it's a good question. Thanks, Robert. And I'm sure every kind of sector head covering different asset classes says something like this, but from our point of view, it's very much kind of real estate ground up in terms of our looking at situations from both an equity investment perspective and also from the point of view of the balance sheet. But that's going to inevitably continue to be the case, as there is so much uncertainty out there with regards how businesses, particularly business space occupiers, evolve their corporate models and therefore their corporate occupier footprints over time. And it feels as though we're at the kind of foothills of that planning, let alone execution process. One of the reasons why the background behind me is all white is not because I live in a cell, but because we're back in the office, but back in a very new office, having relocated during lockdown. And whilst it's still quiet here at the moment, it is gradually filling up. And the sense is that people across the business are keen to have the flexibility to use the office space, certainly when active on deal execution situations. And that, I think, comes back to the point, Robert, you asked me at the top of the call about considering the right time for these options. If you are an owner of freehold business space, then the good news is that there is a large amount of investor demand that gives you optionality over how you might structure the ownership of that from a corporate finance point of view. And IPSX is a very relevant, additive and differentiated venue for you to consider, because it offers that regulated, liquid marketplace, and we're all kind of looking forward to seeing the examples of this first wave of IPOs that will come, hopefully in the not too distant future. Sorry, Roger, if that's teed you up. But against that very kind of positive pull environment is the need for certainty from the investors with regards what the plans for the underlying customer, the tenant, the kind of credit quality of that organization that they are signing up to. And whilst there are definitely some examples of companies proving to be winners by going early and demonstrating that they are sufficiently stable in terms of their plans, that they know what they can commit to in terms of volume of accommodation, amount they can afford to pay in terms of total occupancy cost, and length of agreement, whether it's a traditional lease or something more flexible that they will sign up to. An awful lot of businesses appear to us to still be in a state of reflection. And so there is, I think, a period of time when that reservoir of investor demand is largely untapped and available to the occupiers who are able to decide what their plans are with sufficient confidence that they create a compelling proposition to go and try and access that capital through IPSX across the various routes that you can use the platform.
Yes. And Roger, I guess in terms of IPSX, we know there are a few IPOs coming through at different stages at the moment. So I guess the equity markets are still slightly volatile, but traditionally summer's been quieter anyway. But what are your thoughts on the market and the kind of time to go for these types of IPOs?
Well, on the one hand, of course, what we're doing at IPSX is in its simplest terms just selling real estate. So there's always the right time to go. We all know that equity capital markets traditionally have a season, a cycle to them, and September is usually a very busy time, a very good time to bring new deals to the market. This has obviously been anything but a normal year in terms of its effects. And yet, I guess if I was sitting 6 months ago, just going into lockdown, I wouldn't have, or didn't predict, wouldn't have predicted just quite how well capital markets would operate, and quite how well all of us in our own ways have adapted to working from home. Zoom calls usually work. Today may be an exception. And so, capital markets probably feel in quite good shape, actually. And yeah, as you say, we have continued throughout the summer to have meetings, both generally at IPSX and specifically on potential projects coming through early, of investor education type meetings leading into pre-marketing type meetings. And a market, the investors, as Charlie says, are very receptive for all the reasons Charlie outlined earlier on, are very receptive to these sort of products. So for owners, potential sellers, the buy side is very much there.
And in terms of the investor perspective, maybe Dom can come in on this one as well. I mean, do the investors think that it's mainly the asset that drives the future value, or is it a combination of that and the management team and obviously the tenant and the covenant there? But what's the key features for them in terms of appraising which assets to go for?
Of course, I think it's a combination of those different factors, and I think different investors will probably put a different emphasis on each. So obviously, if we're looking, the area that I work with is occupiers and their real estate, and typically their real estate is relatively bespoke. Often it's not in a prime location. That's the reason why they own it rather than leasing. Now, if they do come to do some sort of monetization exercise, investors are really looking at them as a business, the credit worthiness of the business, and the length of lease. And actually what's become really quite important over the last few years is the mission criticality of that facility. How important is that facility to them and their business? And I think if all of those boxes are ticked, then there is a strong investment pool for that type of asset. I think particularly if you talk about a long lease, probably 20 years plus, the location of the asset actually become less of a priority. But then obviously going into more traditional real estate markets, actually the location and strength of the asset is crucial. So investors can underwrite the relatability of it or the reversion as it may well be. In terms of value, the management of the facility is always going to be crucially important. It does need to be well looked after, well maintained, proper capex plans to continue and get the best use out of the facility during its hold period.
So in terms of the corporate occupiers that you're working with, and what are the broad categories of business that seem to be more prevalent at looking at this at the moment?
Yes, so we're doing a lot of work in the pharma space at the moment.
Okay. Yep.
They're going through quite a change in how they operate. From previously, they would operate a lot of them would have large campus type facilities, which worked for them. Now we see a more of a movement into sharing locations with other pharma groups, basically to support the war on talent. I think if you look at a lot of the historic campus facilities, they would be located in specific locations, particularly driven by tax incentives of the government that are offered to drive them there, and they've maintained in that space for a long time. I think that's changing. So we see now a lot of our large pharma occupier clients looking at their platform now, looking at their real estate platform and what is best to do with it. Can they bring other occupiers in to their surplus space?
That's very interesting, actually, the concept of the scientific village. I mean, that's a big, as well as demographics driven investments like student or healthcare or retirement, which are very busy. But I think science parks and communities around that's a really big growth area at the moment, clearly driven by the need for R&D. But a good example is we're working with the Wellcome Trust at the moment up near Cambridge, and they are not only expanding quite significantly their site for R&D in research and science, but they're also having, I think it's 500 or 1,000 homes as part of the same broad scheme. So the idea of the mixed sites, community engagement, all that is coming to the fore. And I think certainly science parks lend themselves very, very well to this type of initiative in terms of bringing in external investors, because they are very popular.
Absolutely, and I think in that space there are a lot of investors who are looking to deploy capital into the R&D science world. I think what they also do require is some operational expertise as well, because the organizations who would run this do need to understand how they operate. So if that can be tied together, then I think there would be a lot of interest in that space, a lot of capital looking to deploy.
And Charlie, does that chime with what you're seeing as well?
Yeah, it does, Robert. So and I think it emphasizes the point that differentiated and specialist, or at least strategically focused strategies are going to be increasingly in demand. We see that across the institutional private capital markets, excuse me, and also the public markets. The convention of companies having a very focused investment strategy that they then raise equity against and stick to, often if they have a desire to raise more equity to make acquisitions to grow, which may or may not be quite so relevant to some of the corporate occupiers that we're thinking about this afternoon from an IPSX perspective. But to Dominic's observations around healthcare and science parks, they are areas that come up in conversations with investors across the public and private markets on almost a daily basis, because they're recognized quite rightly as being strategically relevant to the underlying trends of how we live and work. And also they are relatively difficult to buy exposure to if you are an investor outside of some of the really very sophisticated private equity funds who've already managed to find a way of buying in, often through ground up development, and that's not something that most investors can run the risk profile of. So those differentiated strategies, data centers, telecommunications, anything that really plays to how our lifestyles and working patterns are evolving are of real interest to the capital markets.
And I guess that certainly a science park would lend itself to essentially selling a minority interest or a significant minority interest perhaps on either IPSX or to a partner, a strategic partner. I guess with that in mind, another question's just come in actually. So the attendee notes that there are no minimum dilution requirements, and owner occupiers could in theory list a very small fraction of their ownership, essentially a minority stake. So he's asking, or she, what protection does IPSX offer minority shareholders? So Roger, do you want to maybe kick off with that one?
Sure. I must confess, I'm not sure I understand exactly what minimum dilution requirements means.
I think it's probably minimum free float.
Well, there are minimum free float requirements.
Yeah.
It's worth pointing out that IPSX is a recognised investment exchange, just like the London Stock Exchange. The listing authority for IPSX is the FCA, just like the London Stock Exchange. And companies that list on the exchange will follow the Companies Acts and disclosure requirements, minority protections, related party transactions, continuing obligations, just like the London Stock Exchange. So the answer is the protections are exactly the same as on the London Stock Exchange. We're no different in that respect.
Yeah, it's very much a fully transparent market. So there are reporting requirements, and there are also some continuing obligations around the need to involve shareholders in decision making. So it is indirect. mean, Charlie, did you want to come in on that as well?
I think Roger covered it very, very well. I think perhaps the question behind the question around making sure, and it's and fiduciary responsibility structures are in place is going to be of ongoing importance to investment managers across the public and private multi-asset manager space, which is perhaps a very interesting pool of investors for IPSX. And so making the point that the IPSX exchange is fully regulated and registered is something that's always worth repeating.
Mm. And I guess that would underpin the valuations to some extent, Dom, as well, wouldn't it?
Yeah, I think that's right. I think from a valuation perspective, we would be very much looking at the asset and the tenant. I think the holding of it is probably a different matter, but
yeah,
as Roger and Charlie both said, I think the fact that it is so well regulated would negate any issues we might.
And if I was an investor in IPSX, I guess there would be periodic valuations provided for the assets to, well, firstly from the point of view of market transparency, but also generating liquidity, I suppose.
There will be Red Book compliant valuations published every 6 months, along with interim and final financial statements, of course, as well. So and also the fact that it's a stock exchange, companies will, if there were anything price sensitive or material that happened in the intervening period between those 6 monthly periods, that would need to be disclosed in a timely fashion as well. So the market will always be up to date. Yeah.
Mm. And it's, I suppose, the key feature of it is it allows both institutional investors and retail investors to have a more direct nexus or a more direct investment into real estate, whether that's something that's part of their local community or a trophy asset or something famous like a football stadium. So there are various facets to the market, but I can see it being a fairly widely held pool of investors into it.
Yeah, absolutely. I mean, I think someone once said that there are two things that everybody has an opinion on: football and property. Everybody
combine the two.
Yeah, everybody uses property. They live in it, they work in it. They used to shop in it. They don't shop in it anymore. So we all have a real very direct connection with property. We all like property. Yeah.
Mm. And you can invest via SIPs and things as well into IPSX stocks.
Part of the reason why it took us a very long time to get our regulatory clearance from the FCA was because at every sort of juncture where we could take a decision to be pragmatic or not, we chose to go for the highest level of regulatory clearance. The clearest output of that, Robert, is that yes, the man in the street can put £1,000 worth of shares into an ISA, a few thousand into a SIP, and they can sit alongside BlackRock and Blackstone, owning a bit of the very biggest buildings. Yeah.
Mm. I guess flexibility is the key, isn't it? So both investment options and options for occupiers in terms of what to do with their real estate. Actually, there's another question come in. Where do investors see the most growth in the short, medium, and long term? Who would like to take that one? Maybe Charlie?
Thank you. That's one of the bigger questions.
Yeah, exactly.
I've been asked recently, and I think it is very much situation dependent. As we've talked about, there is a deep pool of capital available to real estate at the moment, and a function of the depth and breadth of that demand is that it straddles, I think, the entire spectrum of different costs of capital coming from different investment strategies. And we're seeing that played out in some situations that could be described as distressed. related to retail and perhaps the hospitality sectors, where there is a high hurdle to satisfy in terms of the return that needs to be generated to justify investing in an underlying sub-vertical that is still very uncertain, through to the other extreme where we're seeing capital continuing to be raised in the public markets, anything to do with logistics and e-commerce. We saw VGP, the continental developer and owner of warehouses across Europe, very successfully raising equity last week at a very keen price in terms of where their shares trade on an earnings yield and also underlying NAV. And so everything between those bookends, I think, is available to be tapped into by a corporate occupier who has a freehold that they are wondering what to do with. Where they land on that spectrum in terms of cost of capital and rate of return will depend on the credit quality they are able to provide through that transaction and the length and security of income that creates.
And there's multifacets in there, aren't there? But I suppose it's a fairly big topic. Dom, how would you respond on that? Does that tune with what valuers are thinking now, or
Yeah, I think
or is one thing driving valuations more than another at the moment?
I think we're seeing, for the mainstream real estate sectors, I think logistics is the one which is really getting the most attention at the moment. There's still walls of capital looking to invest in that. I think the amount of space required by retailers to operate their online distribution is really driving occupational demand. Obviously, investors are mirroring that. So I think of the mainstream areas, logistics is probably some way to go. Now, but going into what Charlie's been, some of the niche areas and some of the operational areas, obviously we've seen a lot of interest over the last few years in the healthcare sectors and the leisure sectors. And I think that will continue as investors look to get more understanding about the business being undertaken at these real estate. We do a lot of work in the cold store arena, for example. I think that's a sector which has been extremely robust throughout COVID. It's obviously in some ways it's seen as a subsector of logistics, but these facilities are hugely expensive to build, 3 or 4 times the cost of a logistics centre, and we see a huge amount of interest in that space. And again, it's in those instances, it's very much understanding what's happening at the real estate and understanding the business being undertaken. So cold storage, data centers, similar thing. Again, costly facilities to build. There is a lot of capital in already and chasing. So that would be my take on it at the moment.
So that's several asset classes. Actually, there's a couple more questions come in. So first one is very specific. So how does the panel see demand from investors for serviced office and co-working space, given what we've talked about in terms of working trends and more facilities? And the other one is actually at the other end of the scale. So do Charlie and Roger think there is demand for blind fundraising for real estate? So are we going to see SPACs, for example, on IPSX or the wider stock markets for real estate assets, or has the blind pool fund kind of disappeared at the moment? So who wants to go on the serviced office one, and who wants to, and Charlie and Roger, maybe if you want to give us your thoughts on the blind pool funds.
Well, let me say on service offices that it links back a little bit to the question of growth. I think both Dom and Charlie have made the points that the sectors which are very popular at the moment are really just continuing trends which we saw before COVID. They're not a reaction to COVID. These changes were happening anyway, and these operational, long income, well supported income streams are popular. I think, and here I'm going to be perhaps a little bit polemic, I think that if there's one thing that has changed because of COVID or because of lockdown, it goes back to this point that people do not want to work in 58-story towers in the middle of the city anymore. So who's going to benefit from that? Well, it's going to be regional offices. It's going to be providers who can give flexibility to occupiers who want to move quickly to some sort of hub and spoke operation. So yeah, I would think that serviced offices outside of Mayfair and the city probably should benefit a great deal. And I very quickly could
I
deal
would agree with Roger on those points.
the blind pool point, Robert. No, none whatsoever. The stock market is not there for blind pool raisers, and we will not see anything like that on IPSX.
Yeah, there were some experiments along that front in different sectors actually over the last few years, but they did have their challenges. So the market certainly seems to have moved away from those. And I guess with real estate, it's a very tangible asset. So, you know, it's the old bricks and mortar idea, I suppose, that most investors like to physically see what they're investing in and, you know, do site visits and things. So I suspect that general ethos will continue.
I also think it's a question of control, which you increasingly hear people saying they want control. And
yeah,
by that, they don't necessarily mean they want literal economic control of assets, but they want to control their decisions of what to buy, when to sell it. Of course, that's quite an important point about listed real estate, that you can always sell it when you choose to. Yeah, ever more focused, direct opportunities to invest in, and blind pools are clearly the antithesis of that.
Yeah.
And just one point to add to that, which I know is in danger of being a statement of the blindingly obvious, but real estate is in demand at the moment because it's a yielding asset class. And one of the likely consequences of a truly blind structure is that there will be cash drag, and potentially quite significant cash drag, which will always make it that much harder to get the investor demand that you otherwise would be able to access if you have income being generated from day one, which through something that could be described as a sale and lease back or sale and manage back or some other form of corporate structure is the complete opposite, and so therefore that much more attractive.
Yep. So just looking, I think that's all the questions we had. Just conscious of the time, so maybe to close, I'll invite each panel member to mention some closing takeaways or key features that they'd like to say to close the webinar today. So maybe Dom, do you want to kick off?
Yeah, no, of course. So I think occupiers, as we said before, are looking to change their footprint. They are going to look to future-proof their businesses. And I think with that, there is going to be a requirement for a degree of capital. And obviously IPSX, I think, is a great tool to supplement other tools available for occupiers to look to generate money, which they can then support their operational business and make sure the footprint is ready for their business going forward.
And Roger?
Yeah, I would just echo that. It's a new capital markets tool. It's a great piece of market infrastructure which provides a degree of flexibility which must be interesting for owners.
Yes, and Charlie?
So the opportunities I don't think have ever been as broad and interesting as they are now to both investors wanting third-party exposure to real estate and corporate occupiers reflecting on their corporate finance options with regards to the freeholds that they own, and so that makes for a very valuable set of options if you are in that position to consider. And the capital markets are there to support you depending on whatever structure you want to put in place, because of the breadth of cost of capital and rate of return that the capital markets currently covers.
Yeah, I'd echo that. I think there is the demand for real estate. It's seen as a safer, quotes, asset class. And there's a lot of institutional funds, a lot of private equity, all chasing opportunities. And there is a shortage actually of things for sale or for investment, because of, well, on one hand, things like planning delays, but on the other hand, there's just a shortage of things coming to market. So the demand side is holding up, particularly for the so-called alternative asset classes. I mean, retail and offices, I suspect too, may have some challenges in the near term, but certainly the alternative demographics-driven investments are holding up very well. So we are seeing activity. And I think, as Roger's mentioned, the features of IPSX lend itself very well to the idea of wider engagement in real estate, alongside the more traditional options for investors. So I think, yeah, there have been some bumpy times over the last few months, but I think hopefully the long-term outlook for real estate is relatively strong. So 1 o'clock, we've on time. So I'd just like to say thank you very much to all of our panel members. Thanks, Charlie, Roger, and Don. I hope everyone listening in today found the webinar useful. And our details are on the slide there. So please do get in touch if you'd like to follow up on any of the topics that we've talked about today. Do also have a look at the IPSX website. There's the downloads available there from previous podcasts and webinars. And I think a recording will be available of this one as well. So look out for that. So thanks everyone for joining us, and we will catch up again soon. Thank you.
Thanks, Robert. Bye.
Thanks, everyone. Bye.